We see so much online right now that we jump in with something, we expect immediate results, right?
Yeah.
But what is the result that you're seeking? And how important is it for you to get that result, right? If you want to get enough cash flow or passive income to replace your income, well, what is your horizon to do that? Typically, you're not going to do that in a week. But if you can do it in 2 years where you have the discipline to actually stay to it and stay to the plan, if you can get that goal, right? So be patient, but be persistent in your efforts to get to where you want to go.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Welcome, Decoding Cashflow listeners. Today, we have an amazing guest, Jason Yarusi. Jason is an active real estate investor and a syndicator. He founded Yarusi Holdings, a multifamily investment firm with over 2,300 units acquired since 2017. His firm repositions property through operational efficiency, moderate to extensive renovations, and complete rebranding. Jason also hosts the Multifamily Live Podcast and is a founder of Multifamily Live Club with over 3,100 members that focuses on multifamily investing. Jason, welcome to Decoding Cashflow. It's great to have you on the show.
Yeah, Ted, great to be here. Excited to jump in.
All right. So I'm expecting a lot of golden nuggets for our listeners today, and I'm hoping it's going to be a great show. So, Jason, before we dive deep into into the multifamily business aspect, can you please give our listeners a little background about yourself? How did you get started?
Sure.
And where are you currently positioned?
Yeah. So I'd say a nonlinear path, right? I started out of college with a finance degree and then decided not to go that route and got myself into a number of different directions, including working and owning bars, restaurants, and opening and selling a brewery. So I did a number of different paths, basically from about 2001 all the way to about 2010. 2010, 2011, Hurricane Sandy happened, a storm that pretty much decimated the East Coast. My father has had a business that was a very select, heavy construction business where he would actually lift houses, take the whole house and lift it higher for a lot of reasons, but one of them was for flooding reasons. So his business that would do a couple projects a year, say 8 or 10 projects a year, overnight started getting about 1,000 calls a day. So I was working in New York City. I had a bunch of different projects that I either was owning or operating. And then my girlfriend at the time, now my wife, Peely, was working with me and my brother was working for me. Well, we made the decision that we were going to help Dad. So we moved out from New York City, went to New Jersey, and started helping him with the family construction business. So we did that for a couple of years, and we went from those 12 or 13 projects a year to over about 3,000 projects we did in the course of the time that we were there. So you could see how much it exploded. That moment, we constantly were just in service jobs. So I would do one job that I would have to do something, right? So like say tending bar, right? I have to serve a drink to be able to hopefully get a tip, right? Well, the same thing happened in construction. It was so specialized that I'd have to be there doing the activity to be able to have some income. So starting a young family, Peely was pregnant with our first child. We kept asking that question, what else could there be that we could start to get control of our day and our life, right? And we came upon real estate investing, and Peely at the time, pregnant, went out and got a real estate license. We started doing these very highly intensive flips. So we thought that was that first path, but what we found is we're doing all these flips, then we're doing wholesales and doing Airbnb, is that we're basically adding on activity and activeness on top of the construction business that we were still owning and operating. Well, we found someone who was doing out-of-state rentals at a RIA meeting, met that person, saw what they were doing, and just being open to opportunities, we started to transition into that, where we started doing these rentals. Now, they were doing single family rentals, and what we did is we started to do 2 and 3 units, and that opened our eyes to the ability to put together teams, right? Get contractors to get the property renovated, get it leased, have a property management, manage the property, and lo and behold, we started to get income. It was just the income we were getting was so small that it was the light bulb effect that this was something of a path to pursue more. However, it wasn't the right path. I found that people were buying apartments through a thing called syndication, where they would actually pool resources to buy larger apartment buildings. And that was that moment when I said, this is it. I'd understand from having really small businesses and big businesses that if you could understand the core operation, it was the same on both levels, but you had more resources and more economies of scale to do it on a higher level with a bigger business. So the same thing was effectively happening here with the multifamily business, right? So we sold off all of our small properties and went all in learning how to buy apartment buildings. And that was in 2015 to 16. And in 2017, we purchased our first 94 unit. That was in Louisville, Kentucky. That was our first acquisition, did very well with that. And our investors for that property held it at just about 2.5 years. And since then, we've done about 30 acquisitions. 90+% of it has been strictly apartment communities. The other 10% has been self-storage, office, and land development. And that was when we were in New Jersey. We're now here in Tennessee. We have properties in 7 states currently. Of the 30 we've sold, I think 14 have gone full cycle, meaning that we've brought them, put together the business plan, and then now have sold the building to a new investment group and gotten back a great return for our investors.
Okay, all right, sounds great. So the one thing I liked about what you said, right, is you already had an active income doing all the, while participating in your dad's business, right? Lifting the houses and other new construction jobs. And you are wise enough to just move on to the passive income side of it, because that's what I also believe. Everyone needs to have, in addition to active income, everyone needs to have a passive income, because life is too short. You never know, what's going to change. If someone has a job, there's little stability in the job, right? In the current market situation, they may lose the job, or any other situation might arise where they might lose their active income. And the best option is to take out some portion of the active income, start investing on the passive side, so that you have enough equity or enough cash flow built in that you can sustain a period or your life when there is no active income flowing in your bank account.
Absolutely correct. It gives us the opportunity to be open and exposed to really start to control our day and control our time by having investments that offer us a ton of potential, right? So with us and the investors, these have the opportunity to produce cash flow, monthly cash flow. It also has the opportunity to have appreciation, both with the markets we're in, but also through strategic improvements where we can get forced depreciation, and then you get the depreciation and the tax benefits, right? So there's just a number of ways that you can win with multifamily investing, and that's why we like the asset. And what we were doing with these other things that we were doing is that, I enjoyed what we were doing, but we were just so busy, right? And when you start to have a young family and you're so overly busy when you just can't control, right? Just like most things, if you're driven on a revenue base or the construction world, right? You either do the work and create revenue and make money, or you don't do the work and you don't make, it's just strictly aligned to that tie, right? So for lots of us that are out there participating in that level, this was a choice that I had to make, that if we wanted a different result, we had to start changing the narrative. And so slowly but surely, we started to find the best option for us today, right? We have friends that win in many different paths of real estate, but finding apartment investing was the truest form and the best investment for us to go forward and meet the goals that we were having, and also be able to help investors to invest passively with us.
Yeah. And similarly, like in what we do is we do ground up construction for single family luxury houses, as well as small multifamily properties. And we started pivoting to multifamily also back in like 2018. Because we saw an opportunity, where some of the investors, they had an appetite for for only like, they wanted to invest in 1 or 2 years project. They didn't want to invest for 5 years like multifamily, but they want a higher return in exchange. So that those investors, they like to participate in new construction project. Once it is done, they get a high return, next project, move on. Some of the investors, they like cash flow. They like taking tax advantages, depreciation on the properties. They want to roll the same money over and over in different projects once they get it back from, once the property is dispositioned. So, starting 2018, we also, started providing both opportunities to the investors, looking for real estate investments.
Yeah, that's a great fit, right? Because it gives investors both options to be able to have many different avenues so that they can grow their wealth. So it really is a good hand in hand.
Yeah. And Jason, in the multifamily properties, can you tell our listeners, how did you find your first deal? Like you said, you found one in Kentucky, right? Can you tell us more about, because that is your first deal, right? You might have grinded to get the first deal under the belt. So what was it like?
We got very specific with what we were looking for, right? And that usually the energy is that when we go into a new space, we're very broad. And so it's hard for us to identify actually the opportunity, right? Because if you were saying, hey, I want to buy an apartment building, well, there's thousands, hundreds of thousands, out there that we could be a 2-unit all the way up to, 1,000-unit, right? It could be new construction. It could be something built, 1890s, right? So what in fact were we looking for? Well, learning the path of what I was going after, I wanted a building that could sustain to have a full team to work for the property. So a leasing manager, maintenance team, right? Could have the best property managers who typically are aligned with larger properties. So we were finding, our goal was to find 75 to 150 unit property, BC assets built between 1970 and 2005 in Louisville, in the South Side, because that's where predominantly the housing market was right there. So that was our first goal. So we set that out as parameters, as the guide, as the box. And so we got very disciplined to go out and seek those opportunities. And when we were looking for those opportunities, we were also empowering others, right? So brokers, property managers, right? With that this is what we are seeking. Right? We're not going to look at something that's 12 units. We're not going to look at something that's new construction. We're not going to look at something that's in Cincinnati, right? We are solely looking at this market. And what we found is that it gave us the best ability to find the right opportunities, right? It didn't eliminate us having opportunity. It gave us the right opportunities because we knew what we were seeking for. So we found a project through just a network. It was actually a property manager had known this property was coming up because the owner had passed away, and he was in his 90s, and the kids actually had the project. They were managing it from out of state, right? This wasn't their business. They weren't chosen. They weren't thinking to do this. And lo and behold, they have this apartment community that they've now inherited. So he knew this was available. They had a price in their mind, which was for the time outlandish, right? They wanted over $3 million, and they had heard that that's probably the price it was worth. So we made an offer at 2.1 million, because that's what the analysis spoke to us at the time. We said, here's where we are. And they countered exactly at the same price that they started at, 3.2 million. So there was absolutely no counter. So we said, thank you. That's great. We appreciate it. We're here, but we can't come any further. Well, a couple months went by, and I was tracking the properties that we were going after. And I went back and saw that property had not traded, nothing had happened with it. So I went back to the communication of how we had it before and asked, hey, I want to put in another offer to this, think they'd be willing. And the feedback was yes. So I increased our offer only $50,000. And remember, they're at 3.2 million. And they came back within like 3 or 4 hours at a counter of $2.6 million. And what had happened is that the market had spoken, that the price that they had in their mind was not actually the effective price that they could get in the market. However, most of the buyer pool, they had probably put in offers around when I did, and they had forgotten about the property. So being able to track these properties, I went back, and after a little bit of negotiation, we purchased it for $2.3 million. And that was after, just we'll say first offer to last offer, to contract about 5-6 months.
Right. Sounds great, man. So it's the persistence, right? Never keep it loose-ended. Just try to close it out and then get back, to the sellers if the property hasn't sold for a while.
Correct.
Yeah.
Correct.
All right. And in your business, right, as a part of Yarusi Holdings, do you focus on which aspect of the business in multifamily, like as an investor's relationship, property management, operations, acquisitions? What is your main focus?
Sure. So from a point of investment, right? There's usually lead generation, due diligence, asset management, underwriting, capital raising, deal sponsor, right? So on the first projects, we did all of them, right? It was my wife, myself. We carried and wore all the hats minus the property management. As we've grown, right, we've done over 300 million in acquisitions at this time. We have done two things. One is we've partnered with other operators like ourselves where we could both take on the roles and make the project successful. And we've grown out our team underneath of us here. So the two parts of a deal that you have to be able to do to have the deal be successful is, of course, find great opportunities and be able to fund those opportunities, right? So those are the two drivers that you always have to have your main attention on. But here at Yarusi Holdings, that's where I hang my hat. However, under us, we have team on my team. I have underwriting, I have asset management, I have investor relations, right? We actually do property management for about, let's say, 250 units currently in-house too of the portfolio as well. So on that front, we've built out the team underneath us to now support the projects as we go forward.
All right. And talking about operations, right? I know, as I mentioned earlier, your firm, they repositions the property through increasing the operational efficiency. So if you can give our listeners a little bit more background on the steps that you take to increase the NOI of the property.
Yeah, so you can usually do it either in one or two ways, right? You're either going to increase income, right, through various levels of property repairs, right, or just marketing or other, or you're going to reduce expenses. And so we look for what's going to best fit the property. So we look at the property where it stands in the market today, how it matches up to the comparables. So you can look at that as either they are not doing select renovations and those renovations are not garnering them the best income, or they're missing out on other income, right? Maybe they're not charging for late fees, or not charging proper, not billing back utilities, or they're not allowing pets, right? These are all things that start to add to the bottom line. Beyond that, then we'll look at their availability in the market, right? Can you find them? Are they having the proper marketing or having a research? Does the property itself need select renovations? So does it show well? Right? When you get up, is the landscaping a mess, a parking lot a mess? Like the first opinion of the property when you get to the property, how does that appeal to the customer base, to the tenant base? So we'll look at that from the onset to say, okay, how can we gain on the property to drive income? However, we do know there's an existing tenant base there, and we don't want to go in there and be, the new sheriff in town and just raise rents on people without ultimately making the property better. So we'll look to see what improvements need to make to the lifestyle to make this a better community to live. And that can be anything from addressing needs of the property. Many times when you take on a property, it's been have some deferred maintenance, whether they're just not doing maintenance requests in a timely manner, they're not fixing things, or tenants have just learned and been trained not to call because they don't get things done. So we'll walk the property, see if there's any active leaks or anything that needs to be addressed to make the property better, right? That helps start to control our expenses. Then we'll look at other things, whether it be just changing out toilets and changing out shower heads, right, to low flush, and aerators, right, to reduce on the expenses there. We'll see if there's any contracts that potentially we could add on. It depends on the state. Could be utility contracts. It could be anything from trash contracts. It could be cable contracts, laundry contracts, anything where we could take control to be able to, one, drive better opportunities for the tenant base, but two, add additional income that doesn't overly affect the tenant base as well. Both of those together can drive up the bottom line to drive up the net operating income. And that net operating income ideally will hopefully, after all expenses, everything's paid, pay the debt service, can begin to produce more and more distributions and revenue for the investors. Well, what you look with marketing is many times is that it depends. Like if it's a mom and pop owner, they may do no marketing, right? And so they may have no footprint, right? And so without a footprint, especially in today's market, your tenant base predominantly is usually finding you through some online access, right? So if you have no online availability or no presence out there, you're basically eliminating a ton of the tenant base that could potentially just find you, right? So you do that, we get up a new presence. On the other side of it, they could have a very poor online presence. And then we have to make the select choice. Do we need to completely rebrand the property to show that there's going to be a new change here? Because you may take on properties that have just had a bad image. And that bad image, sometimes it's the best choice just to completely rebrand the property, start new, to give it the best foot out of the gate, to say, okay, this is going to be a better place to live. And as you see, we are doing things to make this better. We're basically changing the landscape all the way from the outside to inside. So when a tenant does show up, they are welcomed by a property that's now being controlled in a new environment to be that better place for them to potentially live in.
So in the rebranding, right? Do you also change the name of the property, everything, in addition to
most times?
The renovations? Okay.
Yeah, most times. So we took on a property here where we just assumed a loan recently, and the project had just done a rebranding. However, it's just not marketing well is the thing. They've done a rebranding. It's fine. It doesn't have poor marketing, or it doesn't have poor reviews. It just doesn't have good marketing, right? So we've taken on that property, right? And we have local properties along it that now, because we're buying this property, we get the economies of scale of having more into the market. However, in other times, we've taken on properties where it's just very poor, right? And so when that we do rebrand, we are going to change the name, right? Just change the name, change the effect. This is exactly where we are starting with. So it's a clean divide of where we finished by buying the property to where we started.
Okay. Sounds good. All right. So Jason, I know you have gone through many cycles of this buying and repositioning the properties, right? What is the toughest thing that you have experienced so far, and what lessons did you learn?
You're buying a building where there's sometimes 100+ people living in it, right? And so you have a business plan, but then you have the actual plan, right? You have day one, right? So we've had everything where we've taken on a building, everything inspected fine, right, from taking on the onset, and it had a lift station because the sewer where it was built, it was a 1969 build, was actually now below the sewer with the street because they had raised up the street. So lift station, perfect working order, taken on, and within 3 months of the property, the lift station went down, right? So we basically lost all water to the property for almost a day and a half. And what we did is thank goodness we had the right team there that was able to get us back online. But we were getting, because of the build of the lift station, it was a product that was from overseas. They were telling us it could be like a month. I was like, listen, we don't have a month. And that's where having the right team on board found the right solution to get this back online, right? So we've had that happen. I've had a generator that was locally take out some of the lines, the electrical lines to a building, right? So that happened where tenants were out without utilities for a day, right? So that was another thing that came up out of nowhere. We've had, people pass away of natural causes in buildings, right? And you have to see what's the process with the state to handle this effectively, especially if they don't have next of kin or someone to contact, right? So you have these wild cards that come up because you are just operating a place where people are actively living. And what you can do is make sure that you have the best team in place and the proper resources in place. So when something happens, you have people that are on your team that have most likely seen this or have had this happen somewhere else. And so they have the best guidance to help this plan continue forward, despite the unfortunate circumstance that may have popped up today.
Yeah, absolutely. It's all about, having the right team members and having the right network. If you don't know the answer, you need to make sure that someone on your team knows the answer.
100%.
Yeah. Okay. All right. So, Jason, what are the main, what do you think about the current multifamily market with all the interest rate going up? Do you still find good properties that you can underwrite, or it's like finding a needle in the haystack or you're on the sidelines for now to find the right deal?
We're constantly underwriting deals. Now, of course, there's always drivers that make it more difficult, right? If we go back, 24 months ago, prices were crazy. Loans were, of course, easy and money was out there, right? Now prices are starting to come around. However, loans are very difficult to come across and money is very hard to come by because people are staying on the sidelines. So you just have to look at usually the inflows and outflows of the market. Here, we're in a high interest rate environment. It's gone up historically past any level it has in the past, right? And so if we look at really the past, the Fed, once they have made the decision to start dropping rates, have done at a dramatic fashion. Now, will that hold true to happen again? Who knows? But we do think that ideally with all the rate increases we've seen that we are at the top. Maybe we'll have one more 25 or 50 basis point jump. But looking at even where inflation numbers came out with CPI today, hopefully we're at the top of it, right? So if you look at this to say, okay, rates are high, we're at an elevated state. The only thing that really contrast that to drive down prices is that on the other side, most owner operators are having buildings that are still occupied, right? They're occupied at very good rates. Rent is not going up in dramatic fashion like it had in the last 2 years, but rates are still high, right? And that's because really the supply is still not meeting anywhere to the demand, right? Over the course of the decade, we're still going to be short anywhere between 6 to 7 million units of home, right? So if you look at that, we're not going to meet that. This year was one of the first years that we got close to meeting the demand, but that was because we were in a low interest rate environment where people putting a ton of units online, but now we're still facing higher interest rates to do it again, high cost of labor, still supply chain issues, and inability just to put housing where we need it, right? There's still the government infrastructure that may not want or allow housing to come on at the pace that we need it, right? So you have all those things pushing the opposite way, where the next few years after this, we're going to continue to just have the delta between supply and demand. But we are seeing that some sellers are starting to be more open to different price parameters. And also loan assumptions now start to make more sense compared to where they were 24 months ago. That loan assumptions are starting to make more sense. We just purchased a building here. It was a 32 unit. We got a loan assumption where it was still 7 years left on a Fannie Mae loan and had an interest rate of 4%. Right. So it was a really good one for us to take on, got it at a very affordable price because the guy had sold off his other properties and that he was managing from out of state. And this one was just bleeding him dry because he had too much for a 32 unit. He's got a full-time leasing person, full-time maintenance person. He had all this team that the property just truly couldn't afford. Right. So we were able to get this for us at a great price to fit right in with our portfolio.
And in addition to what you mentioned, right, I would say the rent, the cost to rent versus cost of mortgage when you buy, the spread is still too high, and it's getting wider.
It's getting much wider. Yes.
Much wider. Yeah. So people tends to rent more than buying the property right now, especially the new generation.
It's 100% great point is that if you look here at the renter pool, renters are saying, I hope to buy. However, it's not the right time to buy. And then they hold on and then they don't want to move, right? Moving is not cheap either, right? You got to get all your stuff, a couple $1,000s and go move another spot. And it's not going to be a discount in the rent because there's no available of rental product, right? So they stay longer. But if they jump, right? You had a mortgage maybe 24 months ago, a $350,000 house, maybe it was a $1,500 mortgage, right? The $1,500 mortgage today can get you like a $270,000 house, but there was no $350,000 houses before. So there's definitely not any $270,000 houses now. So you're just saying, man, I'm just going to hang out until things figure their way out. But when does that happen?
And because of the mortgage rates right now, right? 7.5 something, that $1,500 house right now, it's like $3,000.
Correct.
Right. Yeah. Okay. And all right, now, Jason, let's switch the gears and get to the final round of questions. Is there anything specific that you want to tell our listeners before we move on to the final round of questions?
Sure. If you want to learn more about what we do here and a little bit more fully in depth in some of the things we covered today, you can see our investment portfolio, what we've worked on, what we're working on. You can go to yarusiholdings.com. It's YARUSI Holdings.com. If you want to talk more, feel free to schedule a call. We'd be happy to talk to you about you and your investment choices going forward.
Sounds great. All right, Jason, let's move on to the final round of questions. What are your main source of information to learn and grow?
Oh, there is a constant flow, but I like to find select podcasts that talk just about the space I want to be in, right? And so there's so many real estate podcasts. When you come to this podcast, you're going to get great stuff. If you're in the tech space, you're looking for other passive environment, you're going to come here, right? But for me, being in the multifamily space, I wanted to make sure that I was seeking just multifamily podcast, right? So I could really put the blinders on because there's so many opportunities out there. And I knew that I wanted to go into multifamily, so I didn't want to seek any other information that was outside of it. So I'm constantly looking at really just housing data, employment data, driving market data, and then I'm looking at the local market. So I pay attention a lot to where I am here in Middle Tennessee, specifically to Nashville, because this is the market that's our backyard and where we do most of our business. So I do want to be highly attuned to the market so I can truly have a read of what's happening and what can and will happen as forecasted in the future.
Right. What is the best business or investment advice you'd like to give to our listeners?
Be patient. We see so much online right now that we jump in with something, we expect immediate results, right? Yeah. But what is the result that you're seeking? And how important is it for you to get that result, right? If you want to get enough cash flow or passive income to replace your income, well, what is your horizon to do that? Typically, you're not going to do that in a week, but if you can do it in 2 years where you have the discipline to actually stay to it and stay to the plan, if you can get that goal, right? So be patient, but be persistent in your efforts to get to where you want to go.
Yeah. And always learn, right? Learn where you want to get into.
Correct.
And just make sure to assess your risk appetite also.
Correct.
Yeah. All right. What is the one book that had made a major difference in your life or your business?
There's constantly books that I'll read that I'll pick up something from. I don't know if there's one book that's made all the difference. From a philosophical way, I like Meditations, right? So Marcus Aurelius Meditations, that's a good book just on how the world changes, but the same events that we're constantly dealing with have happened for time and time. And so we constantly think that we're in a moment of all the breaking moments, but this has happened historically for time and time again. And so when we look at problems, is it really a problem, or is it just our thought of what the problem actually is, right? So if we can change our mindset, we can change our forecast of how things actually go in our life. And that's a lot about decision-making of how we look at things. And if we want to look at things in a positive manner, well, usually we'll get a positive result, even if it's in the worst circumstances.
It's all about your perspective.
Correct.
Yep. All right. What is the one way you like to give back to the world?
I have 3 little ones now. And to say that, my name's going to engraved in stone somewhere out there into the future, thousands of years ago, or 1,000 years coming is a high order. However, the impact I can have is to raise my kids in a way that they can go out there in the world and have a great impact on others. And I think giving that back, if you can touch someone and help them in a way that they can be better prepared for a successful future, they will do the same for someone else. And that ripple effect is something that can be massive in massive proportions.
Absolutely right. I love it. All right, Jason, last question. How can Decoding Cash Flow listeners get in touch with you?
Yeah, sure. I think I mentioned on Yarusi Holdings before, so that's a great way. Jason at Yarusi Holdings. If you want to listen more to the podcast, we have the Multifamily Live Podcast. I also have another one on peak performance called Live 100 that we recently just came out with as well. Live 100 Podcast. So those are 2 places that you can learn more about me and what we do.
Sounds great. All right, Jason, it was nice talking to you. It was great to have you on the show. We did have, I'm sure our listeners have many takeaways from the show, which they can act on. All right. Thank you.
Thank you.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.